Welcome to the Jones Zone, a podcast by Darryl and JJ Jones.
Hope you're going to like this video. We got a bunch of videos in our video bank, everything to do with real estate. So hope you're going to like it. If you do, subscribe for more and check out some other videos.
Welcome, everybody, to another episode of the Jones Zone. Today, we're going to tackle the big, beautiful bill. Pat Leung is, she actually does my taxes. I can't recommend her highly enough. She ain't free, but she's worth 10 times more than you pay her. That's for sure. What's the acronym? I guess they're saying OBBBA, just to shorten up the old big, beautiful bill act.
The One Big Beautiful Bill Act, OBA. The other big benefit with the donor advised fund is, get this, I can donate appreciated stock. So let's say I bought Apple stocks for a dirt cheap amount of $100, and let's say the Apple stocks is now $1,000. If I were to sell it, I would have to pay tax on $900 of profit. So, I will have post-tax left. So I've got to pay tax on it. So now at this point, I don't have $1,000. I'm going to have, let's say, $700 left to make the donation. But if I use to set up this donor advised fund and I donate that same Apple share, I don't have to sell it. I just take that share and donate it right into that donation bank account. I will get a write-off of $1,000, even though I only paid $100 for the Apple share.
Oh, see what I told you, everybody? I told you it was worth having this person, Pat, to give you tax advice. So, and now how do you set up this donation fund?
A lot of financial institutions has it, Fidelity, Vanguard, not making advertisement for them, but
But it has to be a professional. It has to be designated, called a donation fund or what have you.
Right.
Okay, so you set that up and you start feeding it.
Yeah. I mean, it could be anything, right? Like I have a client who bought Bitcoin back when it was $10,000. What is it now? Like 100 grand.
Oh, yeah. I'm not sure. My Bitcoin is. No, I'm just kidding. I don't know.
So, it's worth 100 grand, around that amount now. And let's say he makes a donation of that one Bitcoin into this donor advised fund. It cost him 10 grand, but it's worth 100 now. He gets a write-off on the $100,000. And he didn't even have to pay tax on it.
Ooh, interesting. And when one would want to meet with you, I know we just met, I think, for our next year. So it's you want to meet the year prior to prepare for for example, you want to meet now to prepare for 2026.
Right.
Okay.
You don't want to talk about like, hey, what can I do? What changes? During tax season, during tax time, what each accountant's concerned with. Let's get you in, let's get you done. You don't have time for planning. The goal is to get you to the finish line and let's just wrap you up and package you up and let's submit your taxes. The planning is done before the December 31st door shuts.
Yeah, and a lot of people probably don't even take advantage of all their donations because, correct me if I'm wrong, when you donate clothes to Goodwill, when you donate things like that, you have church donations count as well, correct? So all this stuff. And in fact, frankly, on that note, on church donations, how do you write off? Can you write off cash? I mean, and you just you have to. It's just a trust thing. You just say, hey, I gave the church $1,000, and
claiming cash is going to be hard unless you ask the church to give you a receipt. Because if there's an audit, they want to see some paper trail, some kind of confirmation of your donation. Just you verbally telling the accountant, hey, I dropped in $10,000 of cash into the bucket. No, that's going to be a little bit hard to defend. But
so safer, just give them a check.
Safer, give them a check.
Do you write it out to God? I'm kidding. I'm kidding. Okay, so you give them a check on that. Okay, yeah, because I'm sure. I mean, I've made donations to charities. I gotta review that now. We got non-deductible donations starting in 2026. Anything else?
So for individual homeowners and seniors, that wraps it all up. So that sounds like not a lot, but there's a lot of moving parts within that, and it's excuse me, people start digging in. there's a good handful of strategies that one can still use to make sure they maximize their deductions.
So, Pat, what in the bill, in this big, beautiful bill, Trump's big, beautiful bill, what changes should homeowners be aware of?
One big, beautiful bill act, OBA, brings some notable changes for homeowners, some of them offering tax relief, others are cutting back on familiar benefits. So whether folks are either buying, refinancing, improving, or selling their home, there are some key changes to be aware of. The first one is the home loan interest. So just to bring you back, Trump 1.0, pre-Trump 1.0, we were able to deduct home loan interest of up to $1.1 million. Trump came in 2017 Tax Jobs and Cuts Act, that got cut down to from 1.1 to $750,000. So it doesn't mean you can write off
That's kind of a
750,000
lot.
interest.
That's a big
No,
deal.
no, it's not.
Oh, no?
It's not
Okay.
a lot. It's not the interest. It's the loan. You can write off interest on the loan, not the mortgage interest itself, but the loan is capped out at 750. In our area, Darryl, that's not a lot. For
Well, no,
700.
I guess that's what I meant. What I meant was it's a big change.
Oh yeah, the change is significant. The exception is if somebody already bought the house, their personal house, before December 17, 2017. So they would have been grandfathered in under the old 1.1 million threshold. Now we're just down to 750. That's not a lot for folks in our area.
Yeah, in California, that's basically almost everybody.
Yeah. The common misunderstanding is that people misunderstand and think this also applies to rental properties. It doesn't. It's only on your primary home. So you can buy a rental property, 2 million, 3 million. It doesn't matter. You can deduct all of that's in the business side.
Yeah, that's
Here,
a cost. That's something totally different. Yeah.
Right. This is on your personal home. The loan is capped at 750.
Now, what about state and local tax deductions?
That one got a boost. So, again, going to pre-Trump 1.0, we were able to deduct unlimited state and local tax. So what is exactly state and local tax? State is what it says, taxes I paid to California, my home state, like for my income tax, and then also the property tax on my house. So let's say, I pay $10,000 of property tax on my home, primary home. My paycheck through there, I pay also another 10 grand. That puts me at 20 grand level combined. Pre-Trump 1.0, we could deduct that entire 20 grand. Trump 1.0 came in, TCJA put a cap on it to 10 grand. So I lost 10 grand of deduction. Now, under Trump 2.0, it's been increased to $40,000 under OBA.
Which basically, in a nutshell, is going to, I think this is what was a lot of the media or there was a lot of talk about this because, and correct me if I'm wrong, but it's really going to affect people that are in high tax states.
Yes.
More so than low tax states. So
Absolutely.
those high tax states, California, New York, Illinois, they're going to
Not only
be
high tax, but high property value.
in high property tax states. So California is going to be basically pressured, I suppose. There's be a little political pressure on reducing those taxes. But anyway, okay,
Yeah.
just to kind of further clarify, it's the lower tax states won't. But go ahead. I'm sorry.
They won't
Proceed.
be a change. The
Right.
East and West Coast basically are going to see this. And again, similar on the individual side, here there's also an income restriction. So for single filers, 250,000, joint filers, 500. Once you go above this threshold, you start losing the benefit. A lot of moving parts on this. And again, this is your personal home, not the rental properties. There's no restriction on rental property. And this is, again, not on the mortgage. So people always get it confused. mortgage and property tax are two separate things, right? When people talk about the cost of home ownership, PITI, principal
Principal,
interest
interest, tax, and insurance. Yeah.
insurance. So principal interest is the home loan portion. That's the one that's capped at $750,000 a loan. And then here we're at the PIT. This is the tax, property tax. So we're looking at your personal home property tax plus the income taxes paid to the state. That's what comprises of SALT, state and local
Interesting.
tax.
And you said there's income limits. What was that again? That's any,
250 for single filers, 500 for married filers.
so after a
So
certain point, okay.
you start losing. Again, a lot of planning that you need to do to get yourself below these phase out thresholds.
Planning, just so I
Planning
can
is key. Yes.
further define planning. Planning is basically, because Pat and I have met off screen many times is just setting up specific retirement accounts, let's say, and accounts like that will get your income reduced, but you still get the money. You just get it in the future.
Right.
Anyway, just wanted to clarify that for.
It's still your money.
Yeah.
Right? You're just moving it from your own bank account to now your retirement account. It is still, at the end of the day, it's still yours. But by moving things around, now you qualify, right? So it's just about shuffling things around, strategizing on what we can do so that you are complying with these requirements and maximizing on the deductions.
And one could look at it rather than give that money to the government, you're giving it to
Right.
yourself.
Exactly.
Yeah.
Still your money.
Yeah. So that's then Uncle
Still your
Sam's.
money. Yep. At different accounts, still your money. The key thing is not writing a check to Uncle Sam.
Right. So Uncle Sam it might have to go on welfare. I'm kidding. Okay. So we talked about PMI.
Yeah. So here's the thing that came back. This thing.
So let's clarify real quick for people though. So when anybody typically when someone puts less than 20% down, their bank, the lender, is going to require them to get what's called PMI, private mortgage insurance. That's insuring their loan if they don't pay it off. The thinking is, mathematically speaking, if there's 20% down and the bank has to take over the loan and we get foreclosed on, there's enough equity there that they can financially wouldn't be such a burdensome thing. So if not, they require PMI, private mortgage insurance. All right, go ahead. Sorry, Pat.
Right. Great explanation. Because of that, some folks needs to pay PMI when they buy their home, personal home. PMI at one point was deductible and it became non-deductible. Now it's coming back. It's like, the in and out fashion. So starting 2026, we can now deduct PMI, but here comes the income limitation, 100,000 only for joint filers or just a mere 50,000 for single filers.
Explain that. Delve into that deeper. So 50,000, you're talking about, okay, income. That's income. And I would guess, oh boy, this is a guess. So typical PMI would range anywhere from $150 to $350 a month, probably. And so let's say it was $200 a month. That's $2,400 a year. You can maybe I'm biting off more than I can chew right now. You can write off $2,400 and that's 35% is $800 or so, 35. So you can save around $800 to $1,000.
Right. But if the individual makes over $50,000, or in the case of a joint filer, they make over $100,000, they start phasing out, meaning they're going to start losing this ability to write off PMI.
So far, it seems as though a lot of this bill is geared towards, definitely not wealthy people, or I guess there's some pros and cons. With proper planning, it won't affect, well, when I say wealthy people, I guess people that are making a relatively good income of six figures or above, or in the high six figures.
You assume that just because somebody makes a lot of income, that there's nothing we can do to bring their tax exposure down. I have in reality, a few instances where My clients are in the seven-figure income, and because they invest in real estate, they have businesses. Through a handful of strategies, tax reduction strategies, we bring them down to zero, single-digit tax bracket, and they look dirt poor on the tax return. And poof, all of a sudden these deductions become available.
Interesting. More reasons to contact you or someone like you, but preferably you.
For homeowners, there's few more. There's this one is going to be expiring the end of this year. It's a bunch of residential energy credits. So the theme with this administration is anything energy related, it's going to start phasing out. So whether it be electric vehicle credits, in this case, residential energy credits, solar panel,
Windmills. I got my windmill. I'm joking.
yeah. So folks that are looking to put in energy efficient doors, windows, any energy efficient upgrades, be sure to get that done. And I don't mean like get a contractor in and on December 31st, like hire them, write a down payment for a check. No, this thing has got to be done by December 31st to qualify for this credit.
December 31st of 2025, just so those who are listening. So you've got to get these, any sort of energy related, how do you explain it again? Energy
related credits.
Credits.
So if they're looking at doing home improvement, like upgrading their windows to dual pane, triple pane windows, and
adding solar.
Exactly. Adding solar, insulation, new doors, anything that's to improve energy efficiency in their home, that's going away.
So you got to do it quickly.
Yes. Yeah. So those are the major changes. Two other things that don't have changes, but I do want to bring that up. And as it relates to homeowners, is the tax-free exclusion when a person sells their home. So again, if this is their personal home, they've lived in it for at least 2 years out of the last 5 years, looking from the date of sale, then they can get tax-free profits of up to $250,000. So for a married couple, that's $500,000 tax-free when they sell their primary residence.
Yeah, that's big. I've got to talk to people a lot about that because that's a huge thing. And in fact, this is an interesting thing you told me a couple of years ago that I don't think a lot of people know is that if you really wanted to leverage this rule, and of course, maybe it's changing now. I should let you finish describing it, but it's not 500 because everybody says 500,000 per couple, which is, I guess, technically true, but it's actually $250,000 a person. So, for example, if a family, husband and wife, have 3 kids and they put all 5 people on title, they could get $1,250,000 gain tax-free. No? Yes? Previously?
It didn't change. The concept is there, but I wouldn't muddle it with putting their kids on because at that point, their kids are not buying it. You're gifting that interest to your kids. But let's just say I've got, let's say somebody with 5 siblings. Yeah. Okay. Or let's talk about 5 siblings. Okay. And they go out and buy a 5-unit property. They each occupy 1 unit. They live in it as their primary residence, as their main home. And then they've lived in it for at least 2 years. And then they turn around, they want to sell it. Each person can get up to $250,000 tax-free gain. Right. So that gives them over $1 million, $1.2 million of tax-free profit. They have
to live in it. Wouldn't it be more convenient? Because to get 5 siblings to go live in five-plex is kind of be challenging. For example, for my wife and I and 2 children, when we bought the current house and we put all 4 of us on title, then in 20 years later, we could sell it and we'd now get $1 million tax gain, tax-free, opposed to normally a 500,000 tax-free gain because it would only be my wife and myself. Is that no or no?
No, because when you put kids in there, there's a few issues. IRS is not going to deem the kids having any cash infusion to buy it. It's really
Okay.
looking like the parents gifting interest in the house to the kids.
Okay.
I don't want to muddle it with kids because now we bring in gift tax issues.
Okay.
And also, you don't want kids to be owning properties. Kids are like in their younger years, they have a lot.
But
Realistically, they have more
and they,
liability.
and they have to live there too, so that's another thing.
Yes,
Okay, so forgive me. That was a little
yeah.
detour. Let's get back to what
I
has
mean,
changed.
or let's make it easy. Let's make it like two couples. Let's say you and your wife, and then perhaps your brother and his wife. So there's four head count now. Um,
I've had a
now we
transaction like that where I had two
right,
couples buy a duplex, and yeah,
right, exactly. That's
yeah.
easy math. Do each couple get to occupy one side of the duplex, and then 2 years later, you guys want to buy something else, sell it, and then now the four of you guys qualify for up to $1 million of tax-free gain.
250 each, just for yeah. Okay. So what is it? What's changed with that? No home gain
No change.
exclusion up.
No
Oh, okay.
change.
So
That
there's
is
no
not
change on
matching up.
that. So that
Yes.
remains the same. That's a big deal. I tell you,
Yes.
I talked to so many people about this. In fact, I had a interesting talk where I had a client who she's 95 years old and she was going to she bought the house 50, 60 years ago and, for pennies. And
Right, for
it's
fun.
now, yeah, yeah. And it's going to sell for, I don't know what we're going to sell for, probably 900,000 or so. And she was actually going to delay because she had heard rumors that Trump was going to no longer have capital gains or the government was going to try to push that through. And I had brought up to her, asking her questions about, and she had actually had her spouse was passed away 10 or 15 years ago. And just so people know that tax basis gets reevaluated at their time of death. So her tax liability was not nearly as severe as she had thought it was, meaning and making it a lot more reasonable to go ahead and sell now because her tax liability was far less. If you need any more questions on that, call me directly or Pat, and we'll explain your unique situation a little bit more in detail.
A lot of on this side of the bank, when people sell, there's the tax exposure. And there's a lot of stuff that, like you mentioned, people don't know about the step-up basis when a spouse passes away, and then the remaining spouse gets the step-up basis. So their basis is not the $5 that they pay for upon, purchase 50 years ago, but really the step-up basis upon the last spouse death. And
Yeah.
then now we look between the delta, today's value, and the step-up basis. That's where we look at the taxable profits.
Allow me to explain it real quickly with a math problem. So suppose if they bought it for 10,000 and they sold it for 1,210,000, they get the first 500,000 tax free, but then they basically owe around taxes on it around 700,000, to where if the spouse passed away when the property was, let's say, valued at around $1 million, and then they sell it, they have actually no tax exposure, tax liability, because it gets reevaluated. That $10,000 that they bought it for goes all the way up to the $1 million, the value of that property at the date of death of their spouse. So it's a big deal, and it's enormously important people realize this. There's hopefully a good way to kind of understand it.
It's complicated. The best thing is to contact professional advisors like you, like me. This is not something for folks to be Googling. There's a lot of misinformation in TikTok and social media that people are dealing with a lot of money at issue. Internet is not the answer. It's professional advisors.
Well, that's for sure. And in fact, and we do that a lot, meaning, so someone will call me and they'll tell me that for that person, for example, that particular client of mine, I had to go back. I think her husband passed in 2010, and I had to go back and just pull comps up at 2010 were like for like properties and what they sold for. And we made an educated valuation or appraisal that it was worth X amount of dollars. So it can be done. We do it all the time, frankly. So if anybody needs that done, you contact me. I can get that done for you for free.
Yeah. Yeah. One other, while we're in line with homeowners, one last item I want to bring up. It's not changed, but I do want to bring it up because it relates to homeowners. We have now a lot of folks that are sitting on the sideline looking to buy, waiting for interest rate to drop, and prices are at an all-time high. So they need to accumulate as much down payment as possible. So folks are looking at different angles. I just want to bring up two options for folks to consider. First of all, there is a option to withdraw up to $10,000 from their IRA, no penalty. They do have to pay federal and state tax, but there's no early withdrawal penalty if they were to use that money to buy a primary residence.
And it doesn't have to be your first primary resident, making your
It
second.
does.
Oh, it does have to be your first
for
home.
the first time. But this is how the IRS defines first-time home buyer. It's somebody who hasn't owned a home for 3 years.
Oh, okay. So
if I sold it, say COVID time, right? It's been more than 3 years now, and I'm sitting on the sideline waiting for a good deal to come along, I qualify under that definition. And then also for folks who have a chunk of 401k, account, they can also take a loan from their own 401k account. They have to repay it with interest, but they can borrow, and it's as long as they repay that money, it's not taxable. There's no penalty. So there, and it's up to 50,000, 50% or 50,000. So there, I've come up with 60 grand down payment.
It's funny. I just closed escrow for a good friend of mine in high school's daughter and her husband. And she was talking to me about how often they hear about people, gosh, we're getting priced out of the market. No young people can buy a house. And she actually said to me, you should do a podcast about this because my daughter and her husband, her daughter's a teacher, her husband's a fireman. They bought their first house. No problem. Got it. It's a little bit easier than one may think, or it's not as unattainable as a lot of young people think. With proper planning, this advice, for example, not to mention paying down your debt and things of that nature, that young folks can still buy houses in California. You've not been completely priced out of the market. Some have, but a lot of people, you'd be surprised, have not. So it's something to absolutely look into.
Thank you for watching. If you liked the video, please subscribe for more.